Hello and welcome to the Market Outlook. This is Jeff Bish, president of MarketGauge.com, filling in for Keith for this week's Market Outlook. So I'm going to focus this video on a few things that I think are the key areas that we need to keep an eye on for the coming week. The big picture here in the markets as viewed by the four major equity indexes here, the SPYs, the Qs, the Diamonds, and the IWM, is the fact that all of them are in their own form of consolidation near significant highs. And I would look at them, these are the daily charts, and there's your rough consolidation. Now, the other thing that's particularly noteworthy is that the Dow has not broken out to new highs in March, whereas the other three have. So there's a divergence there. But the other divergence you want to pay attention to here was the divergence that has really happened in the last couple days. And that is that the Qs, this is Friday, really got hit hard. And they got hit hard relative to the other three indexes because of the biotech sector. That's not a very bullish sign. The SPYs also tried to rally, break to new highs, and then close on the lows. That's not a very bullish sign either. Now, Friday was options expiration. I think it was actually quadruple quadruple expiration. So the market action can be a little squirrely on those particular Fridays. So we'll see how this week pans out. But with the really heavy action in the SPYs, in the Qs, and even IWMs closed near the lows after trying to attack their highs, there has to be a bit of caution this week. That said, I always like to know where I'm going to really get concerned on the downside. So for the Qs, that level is the low end of the consolidation. For the IWMs, I would look at the last 4 days of consolidation, call a break below there, the warning sign for the downside. On the SPYs, I would look at this level as the warning sign. And when I say warning sign, what I mean is that the markets are in this consolidation period. There's going to be some bouncing around. The markets may sell off. The question is, should you be concerned that the sell-off is going to turn into a bigger picture sell-off, or is it something where you should be looking to take advantage of the weakness, assuming that at least the consolidation that we've been putting in is going to hold? So that's what those lines for me represent. Now, without going into too much length about the fact that the markets have had still an incredible run that has not really seen a very significant breather. This means, so this black line is the 200-day moving average. And I like to be able to look at the markets scrunched up like this. And the fact that we have not touched back on the 200-day moving average in such a long time, just by its very nature means that the markets could use a rest back to the 200-day moving average. When that happens, it's not going to feel good. Is it going to happen now? I don't know. But those lines that I just drew are the levels that I would watch out for. The action on Friday is action that I would be concerned about. If we start going back up, I wouldn't be a screaming bear. Now, let's take a look at the IBB. The IBB is a bit concerning because the IBB and Biotech has been a very strong component of the bull market. So the question that we have to be asking ourselves is a combination of the little bit of scare that Janet Yellen put in the markets this week and one of the hotter sectors of the bull market really getting hit hard. This is the 50-day moving average. Is that a sign that the markets are finally ready to put in a significant correction? It very well could be. So IBB is an area that we want to pay close attention to this week. The bulls are going to want to see it bounce back off this 50-day moving average and then start to establish some kind of trend back up over that trend line, back over the 10-day. It's going to take more than 1 day most likely to do it, but that's one area you want to keep a close eye on. The other area with the tensions over in the Ukraine, interesting area to keep an eye on would be the Russia ETF, RSX. It's got a really interesting pattern here on the daily. You can see the gap down and the flush potentially, strong rally back up. This is where the market should hold. Here's the prior swing low. Here's a correction back into the sharp rally. You'd want to see it hold right in here if this is in fact a flush. Now, the thing that makes this even more interesting is the look of the longer term chart. So here's a monthly chart on RSX. The line for me in RSX would be somewhere between the 23 level and I think the 24 level. This is longer term. If you can get back up through there, then this low here could be a significant flush. And if the markets are moving back up, if that market is moving back up, it would mean it would be a good indication that the world is looking at the tensions there as being contained, not over necessarily, but contained, and equity markets have digested it. All right. If this continues to go lower, it would be an indication of just fear that the effect on the equity markets is going to continue to be a negative one. That said, the flush that we had, it could be all the equity markets needed to at least stabilize the equity markets from that point of view. The other place you want to take a look at to assess whether or not the equity markets are going to have a significant decline would be interest rates. Now, if we look at the daily of the TLT, it's got a really interesting consolidation pattern at a really interesting spot, just like the stocks, right? So all this consolidation that I'm pointing out is fuel for a significant move in one direction or the other. The key level in the TLTs here is pretty much breaking over. I'll get the specific number, more specific number, over, let's call it about the 109 level. Clearly the 110 would be a clean break, but if we start getting over the 109 and breaking out through these highs, then that's indication that the rates are coming back down. It could be a flight to safety, and if there's a flight to safety, it's probably not going to be good for stocks. All right, so while I don't want to say definitively that TLTs dropping would be positive for stocks, the TLTs rallying in a strong way, if it's perceived as flight to safety, would be a negative sign for equities. So keep an eye on those TLTs, and even just as a trade, breaking out of this consolidation in either direction is probably going to be a good trade. We're right in the middle of it now. It's hard to predict which way it would go, but it's definitely something that we should be paying attention to. The other two areas that I would pay close attention to are the semiconductors, which had a very nice breakout on Thursday. It pulled back on Friday, but really it's just pulled back to support. So if the markets are going to be strong, good chance that the semiconductors are going to hold this, let's call it 44.5 level, and move higher. If the semiconductors come right back down and fall early in the week, then this could be a huge head fake, and that is not what we'd want to see in terms of the markets, the stocks. The other area that has a very similar assessment would be the financials, and let's take a look at the XLFs for that purpose. So the XLFs did make a new high. SPYs couldn't do it. XLFs did make a new high, but they fell back down below. I would really look at this and say, if we can hold the 2217 level, 22 level, they're still in a very healthy uptrend. And if XLFs and SMHs can manage to hold on, even if it's just consolidation, that would be a positive sign for stocks. If there's a head fake though, you just don't want to see a head fake. And I'm not saying that the head fake is going to do exactly what happened here, but this is a really good example of a head fake. Everything looks great, breaks out, and within 2 or 3 days, you're back into that consolidation. You establish a low, and then you break it, and there's your head fake. So what I'm saying is if we establish consolidation over the 2217 level, that'll then be your benchmark. And that's how I've drawn the lines that we've come up with so far. Now, if we look at the internals of the market, just quickly, as one final way to judge the market. I'm going to look at two internals, market internals charts. The first, let's take a look at the VIX. The interesting thing about the VIX is that as the markets have made new highs, or pressured new highs, you would have expected the VIX, and this is the actual index, to be pushing closer to its recent lows. But instead, the VIX has had a very steady hold above the 14 level. And so, again, if the VIX starts to rise, would not be surprised because it's been so strong. Maybe it's because of the tensions in the Ukraine. Whatever the issue is, clearly the VIX is telling us that the market is a little on edge. And that's a common theme if you look at the IBBs, if you look at the TLTs, as I've pointed out. That said, the VIX isn't at an extreme. This is the 50 and the 200. The Bollinger Bands that we're looking at, it's right in the middle. So there's really no indication, as the way we typically look at it, as to which way the market might go based on the VIX. And I'm going to say the same thing about the McClellan and basically the advanced decline indicators, sitting right in the middle of the range. So there's no real good tell here in the VIX. There's no real good tell in the advanced decline numbers, and the market, which is really also indicative of all the consolidation. So the key here for the next week is to keep your eye on the key levels of consolidation and let the market tell you which way it wants to go next. Based on the level of consolidation that I've pointed out in this video, the next move could be a significant one in either direction. Hope that helps, and we'll see you in the next video.